because they will come in, they will close it.
No,
So,
and a lot of us saw that personally, and we saw it with our clients back in 2008 and 2009. A number of the banks closed off the home equity lines. So we had advised our clients to get lines as an emergency fund, right?
right.
And then, and then the banks that were having all the financial difficulties closed off the line or severely reduced the amount of line available. Sure.
So in this case, they can never do that with this type of reverse mortgage.
Sure.
This is federally insured. So they're paying for this line of credit every month, 1.25%. So you can tap in if the values dump like 2007, yet your line of credit is way above it, you still have access to all that money. You're paying for that security.
Sure. Absolutely.
Okay. Okay.
I have seen studies where in really good years, they're paying money back into the HECM so that it may make their portfolio a little bit lower, but it increases the value of the HECM so that it be more available for long-term care or whatever that they need in the future.
Sure thing.
Yeah, and the other thing is you can really set up your distributions any way you want, and you can change them around anytime you want to. So
I guess we've got 10 minutes now.
Okay, and we're almost done. And so obviously this is the HECM lifeboat. That's just what we talked about. So, you know, I look at the home as, you know, the lifeboat behind the big cruiser, and it's there if you need it. If you don't, that's great. This kind of just gives you the conclusion that obviously by doing that coordinated strategy, you're looking at a bigger legacy as far as the heirs are concerned and so forth. And that's the biggest thing is the heirs think the home is the legacy, but actually if you can conserve the portfolio, that's really the true big legacy. And just by utilizing that home equity in a responsible way, you can actually enhance or increase the legacy for them. And that's why I spend 90% of my time is just trying to educate all family members in regards to that. So.
Hi, James. Welcome here. The recorder is working this time, so I'll be able to post the recording probably sometime tomorrow.
Thanks.
Go ahead, Chad.
So in conclusion, it's just about roll-to-roll applications as far as what your peers are kind of utilizing this for, just planning for the future. You know, a lot of times it's just replacing that mortgage payment so we can increase the income every month. Just a good standby portfolio protection, just what we talked about as far as utilizing it as a coordinated strategy. Emergency access and ability to maybe purchase some needed long-term care, depending on how old they are and so forth, in that case. And we haven't really dug into it, but a whole nother aspect is as far as purchasing a retirement home or second home. And that's probably maybe for another class, but there's some really cool ways as far as not depleting your portfolio to buy a second home cash. You can actually, you know, maybe take half of what they wanted and get a home without a mortgage payment. Tax management tool, that's kind of what we talked about as far as deductions. You know, it's for a different class that maybe they're getting those big required distributions and so forth, and we can utilize that to offset or bring down their tax bracket. The big thing right now is also the Social Security and maybe annuities, just extending or delaying their draw date for those. I'm doing one where the financial advisor wants to delay by 1 year. So all we're doing is setting this up. We're going to utilize the equity to supplement the income until, you know, we can start those annuities, and it's at a higher amount than if they started today. And it would help them throughout their life, and we can turn off the home equity and let that grow for future needs. And obviously gifting the family, philanthropy, and so forth. So that was it. I hope I didn't go too fast. I knew I didn't have much time, but be happy to answer any questions.
Did you have any questions, Nicole?
Yeah, sure. The examples they show in the book show $7,000 worth of origination fees on let's call it a $200,000 loan amount, and that it just seems really high. What are you seeing are the origination fees?
Yeah, here's a lowdown as far as the costs involved, which most people, won't talk about, but I'm not afraid to. It really comes down to what the starting loan balance is. Let's say they're paying off a $200,000 mortgage, right? So they're starting with a loan balance of $200,000. In my case, I could utilize, because at $200,000, it's kind of like life insurance, where I'm getting our lender is getting paid money from the vendor. So I can utilize that money to offset the closing costs. And right now at $200,000, I can probably almost make it a zero cost loan, because I can give a lot of those lender credits back to the borrower. Okay. But if you have a borrower that's just opening up the line of credit, you could see I'm not starting a balance. So I'm not getting money from the vendor because there's no loan balance really getting started except for the closing costs. Does that make sense?
Yes.
So in that case, I may have to charge a little bit more. I may have to charge the $6,000 or $7,000 just to get the loan started. But it's just their equity. They're not coming out of pocket, and they're going to make up that equity down the road. And to have all these features involved. So yes, it can be expensive if they're not starting off with a loan balance. But it's less expensive if they are starting off with a loan balance. Does that kind of answer your question?
It does. It does. $6,000 or $7,000, whether I'm paying it or it's getting wound into that loan. It just is sticker shock for some of these folks. Is there? It
is. It can be. Every case is different. Like I said, unfortunately, it's not a perfect recipe as far as the closing costs. But if you can see the value of the loan itself, even other financial products, sometimes you have to pay some money to gain that security, to gain that guaranteed aspect of the product. And this isn't anything else different. If they don't, if they're putting it in place. But yes, it can be a sticker shock.
Okay.
Did you have any questions, James? I know you came in late, but I assume you've been reading the book or articles.
I came in late, but I have been reading the book, and I've had a mortgage person here locally talk to me about it in the past, so I'm kind of familiar with it.
Did you have any questions that you want to throw at Chad? Oh, by the way, Chad, this is James Falcon from...
Hey, James.
How are you doing? The only question I had, you said if they brought the loan value down to zero, it's possible that they could close the loan out?
Yes, they will close the loan out.
So let's say
most people don't know that.
If they set the loan up and pay that $6,000 or whatever the dollar amount is out of pocket, and the loan starts out at zero, would they have to have some balance on there in the beginning?
Yes, sir. You would want to keep a balance on that loan, be it $500, $1,000. It can be very minimal, but yes.
Okay. The FHA premium is added on to it also every year.
Yeah, that's just the monthly 1.25% of the unpaid balance. I mean, if it's $1,000, there is a cost to have that line of credit in place every month. but the rewards down the road could be huge. So.
I'll send you a copy of the slides as soon as I can, James, but and we'll have the recording up for you tomorrow. He actually uses some of the studies that Wade Flew has done to illustrate how it would
Right.
work.
All right. Well, good. I'm kind of done on my end. So I don't know if there's any other questions.
Nicole?
No, thank you. No.
Well, thank you much, Chad, for your making the presentation for us. I really appreciate it.
Oh, you bet.
And I was not aware that with the credit that you have available, that the closing costs could be almost wiped out if you're using it to pay off the outstanding mortgage.
Exactly. Yeah, and most people don't. Yeah, so you know, especially here, what we do it within our company and so forth. You know, we're a little bit of a boutique type company. We don't have Tom Selleck pitching our stuff on TV, so we don't have a lot of marketing costs. So we can utilize that stuff in a different way. So.
Okay, that's great. Well, thanks, James and Nicole, for joining us.